Let's talk about a story you've probably never heard, one that's playing out right now, deep inside the world of finance. It involves a multi-trillion-dollar market that is being completely reshaped by AI. And, well, it's creating a brand new class of winners and losers.
Okay, let's start with a number that's almost hard to wrap your head around. $2.7 trillion. That's the amount of money the financial giant Apollo Projects is going to be spent on AI projects between 2025 and 2029. We're talking about an absolute tidal wave of capital.
You see, that kind of spending creates a massive, massive need for funding. This isn't just an equity story anymore. It's a credit story. And it's posing a critical question that, believe me, the entire financial world is scrambling to answer right now.
And the answer to that question? It's creating this huge split down the middle of a quiet but incredibly powerful corner of the market called private credit. That's basically loans made by big investment firms instead of traditional banks. AI is no longer this single, simple trend. It's a force that is splitting this world in two.
So, to really get what's happening here, we pretty much have to throw out the old playbook. The way investors have thought about private credit for years is changing, and you need a brand new mental model to really grasp this new reality.
And here is that model. It's called the AI barbell. Think about it like this. On one end of the barbell, you have this huge, incredible opportunity to finance the physical build-out of AI. We're talking data centers, power grids, all those GPUs. But on the other end, you have a direct threat to what used to be the safest bet in the entire industry, software lending.
And this really lays out those two opposing forces so clearly. In the winner bucket, you've got the firms that can handle these really complex, asset-backed deals for digital infrastructure. And in the laggard bucket, well, that's where you find the firms that are heavily invested in software companies whose entire business models could be turned upside down by the very same AI.
Okay, let's focus on the opportunity side first, the winner side. This is where you can see a massive new market being built from the ground up, and it's where the really big money is flowing. But it requires a very specific set of skills.
So, who's in the best position to win here? It's not just anyone. It's the firms with a very particular skill set. They have to be able to analyze the cash flows from something like a data center, which is totally different from a simple software subscription. They have to understand complex leases on ridiculously expensive equipment like GPUs. They need access to patient, long-term capital. And, this is key, they need to be able to write enormous, customized checks to get these massive projects off the ground.
And just look at the scale we're talking about. Apollo recently backed a $5.4 billion deal for data center and compute infrastructure. This isn't some small speculative bet. It's a monumental investment in the physical backbone of AI.
And it's definitely not a one-off. Blackstone, another huge player, has pumped its financing for aligned data centers to over $1 billion. Why? Specifically to support the growth of AI and high-performance computing. The race to fund this infrastructure is absolutely on.
All right, now for the other side of the barbell. This is where AI stops being an opportunity and starts looking like a potential threat. It's where yesterday's safe bets are quickly becoming today's biggest question marks. For years, lending to software as a service, or SaaS companies, was seen as a golden ticket. It just seemed so stable, right? You had predictable, recurring revenue, super high margins, and they didn't need a lot of capital. It was pretty much the definition of a safe loan.
But here's the big, disruptive question. What happens when a new AI can do the job of an established software company, only faster and cheaper? Just imagine a company that sells project management software. If a new AI can organize all your tasks and deadlines just as well, why would you keep paying that subscription? All of a sudden, that durable, recurring revenue doesn't look so durable anymore, does it?
In this chart, this points to some real stress brewing just under the surface. It shows the rise of something called payment in kind, or PIK interest. That's when borrowers who might be tight on cash are allowed to pay their interest with more debt instead of actual money. It's basically like paying off one credit card with another. The fact that the share of loans with this feature has more than doubled, that can be a serious red flag that some of these companies are really struggling to generate cash.
So look, this isn't just some theoretical problem for the future. Investors are placing their bets right now. They are actively separating the companies they think will thrive in this new world from those they believe are most at risk. This table really shows us exactly how sharp investors are thinking about this. Right at the top, you've got Apollo and Blackstone, who are seen as the prime beneficiaries of the whole AI infrastructure boom. Down in the middle, there's Ares, a great firm, no doubt, but more tied to that classic software lending model. And then at the bottom, you have Blue Owl, which is seen as the most exposed to this software anxiety and is therefore considered the riskiest bet of the bunch.
And this thinking has led to what Wall Street calls a high-conviction pair trade.
The strategy is simple, really. You go long on Apollo, betting on its success in financing the future of AI, while at the exact same time you go short on Blue Owl, essentially betting against the firm most exposed to the anxieties of that old software lending model.
So let's just step back for a second and nail down the single most important takeaway from this entire shift, because this is a fundamental change in how capital is going to be allocated for years to come.
This quote just perfectly captures the two-sided nature of the AI barbell. For the firms that can finance the physical build-out, AI is creating a brand new super cycle of opportunity. But for those who are tied to the legacy software models, it creates a brand new and very, very difficult underwriting problem. They now have to figure out how risky these loans actually are in this new world.
And that's really the thought I want to leave you with. As this massive technological revolution continues to unfold, the ultimate winners might not be just the innovators building the AI itself. They might just be the financiers who have the scale, the flexibility, and the foresight to fund the very infrastructure it all runs on. The real question is, who's it going to be?